at Wells Fargo, they made one mistake that maybe I've made from time to time, which is incentives work, and they came up with improper incentives, and it worked, and so they incented bad behavior instead of incenting good behavior, and that happens from time to time. You can put too big a commission in something or the sort.
But let's talk very specifically about what incentives were created. They were incentives that rewarded people for the number of new accounts that were opened.
They regularly on their investor presentations would say we've got so many, and 8 would be great, and 6.2 was better than 6.1 products. So they put this huge emphasis to the public out there, as well as to the employees, but to the public, that they had more services to
their shareholders,
as shareholders, and everybody listened. And surprise, surprise, people started creating fake accounts, and when bad behavior gets in there, other people figure it out. I mean, if you get rewarded for bad behavior, you're going to have a lot of bad behavior. That's a problem. I'm sure it's a problem we've had from time to time in Berkshire and other places. But the real problem was, when you find out about it, you've got to stop it immediately. I don't know the details about why it wasn't stopped, but I've seen that before. And then it just gets out of hand. And if you don't stop it immediately, then if you do it 4 months later, everybody will come and say, well, why didn't you do something 4 months earlier?
But let's be a little more pointed with this. This was not just a case where Wells Fargo was not stopping bad incentives immediately. It was quashing whistleblowers who were behaving properly and firing them.
I don't know the details too much on that, but
from what's been reported, I don't know this firsthand. I don't know this firsthand, but from what's been reported, there have been many whistleblowers who said that they were trying to do the right thing. They tried to report it, and as a result, they wound up losing their jobs.
Once you have not done it, you're in the soup. I mean, John Goodfriend in April of 1991 got word that Paul Moser, a trader in government bonds, was doing something that was very wrong. And he absolutely, John was not profiting by it. He didn't know about it. But the next minute, he had to pick up that phone and call Jerry Corrigan at the Federal Reserve of New York. And everybody thought he was going to do it in the room, but it was unpleasant, or he got distracted. And then on May 15th, Moser did it all over again. And now the position you're in is you call up, and you knew that this pyromaniac was out there who would set fires, and you let him ride another match, and then you're in big trouble. Anyway, you have to act. I mean, Charlie's been very good with me on things like that. If I tell him about anything that's a problem, I mean, he doesn't let me procrastinate. And I might procrastinate otherwise. It's a very human trait. But anyway, and then they uncover other wrong things as you get into it. Now, a couple of our great opportunities came from similar situations. I mean, Geico had a CEO in the early 70s who refused to accept the fact that the loss reserves were developing badly. Now, if you refuse to accurately assess your loss reserves, you also don't know your costs, because you sell the product first, and then you start kidding yourself on the costs. And then you get in a hole, and now your reserves are inaccurate. Maybe you figure it out, but then you've got to admit it if you do it, and it's just easier to shut your eyes and hope that something good happens. And it essentially bankrupted the company. Now, that was a huge opportunity for us, because Geico was a solid company underneath, but their balance sheet was a mess. They needed to raise capital. They almost got their licenses withdrawn, and we bought half the company for less than $50 million. So the fundamental business that Wells Fargo, they've still got the accounts. They've got the loan customers. We do business with them every day. And incidentally, other banks ran into many other kinds of trouble in the 2008-9 period, more on the selling bigger stuff, maybe mortgage-backed securities or something of the sort. So the banks had their share of trouble, but Wells had theirs in a particularly egregious way, which was really kind of thumbing their nose at the public. They made way, way, way less money doing that than if they were bundling big MBSs and raking it in by the tens or hundreds of millions. And the fines were big, even bigger. But going forward, You can stop bad practices. They should be stopped earlier, and they're much earlier, easier stopped.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.